Another picture we use to explain permanent cash value life insurance and why it is a great asset class is through the capital efficiency test. The capital efficiency test has 4 bars on it. Green on the left, the insured deposit fund or cash value life insurance. Brown on the right, that's the equity bar. And yellow and blue in the middle, yellow being fixed income and blue is dividends. Before we dissect the numbers, it is important to realize that I don't care whether a person has $10,000, $1 million, or $100,000, as it is just a difference of zeros. And I can guarantee that the person that has $10,000 looks to their assets with the same passion, excitement, and fear as the person that has $1 million in their bank account. So what this graph shows is that if a client puts in $1 million into cash value life insurance, and they have done so by depositing $100,000 a year from age 45 to 55, it will produce a lifetime income after tax of $87,000 until age 100. If the client funds this instrument from 45 to 55 and then lets it accumulate and begins withdrawing at 65, so we're drawing from 65 to 100, that's 35 years and we're not outliving the money. There are many different ways to withdraw from cash value life insurance, but that's a subject for another entry. To use this as an example, we are simply saying how much capital would an individual have to accumulate if they're following a fixed income strategy, a dividend strategy, or an equity strategy. And they were not taking advantage of cash value permanent life insurance, but they still wanted to have an after-tax income in the province of Ontario of $87,000 a year. Simply, we recommend taking that money and put it away in cash value permanent life insurance, and that'll do the job. But if there isn't cash value permanent life insurance, we would need to accumulate $4 million of fixed income instead of $1 million, assuming we can get 4% to produce the same income. If we looked at common stock instead, we would need $5.6 million producing a 2% dividend annually to net the same income. Now, instead of the lifeboats of fixed income and dividends, if an individual chose to take a ride on the stock market, they would still need $1.6 million invested, hoping for a guaranteed 7% annual rate of return without any market corrections or collapses. So why would anyone with an ounce of common sense risk $1.6 million when they can virtually put $1 million into an instrument that has never failed to make a profit in the last 130 years? Why would someone hoard $4 million of fixed income or $5.5 million in dividends? Why would they hoard it for themselves when all they had to do was allocate $1 million into cash value permanent life insurance? They could give away the difference today, and having the joy of giving this legacy, creating the impact of giving to others while they lived, and experience the joy of giving, because it is greater to give than it is to receive.